Hey, did anything happen this last week?
Rate cuts, elections. I don't know.
Did anything happen? It was very uneventful. It was a throwaway week, right? Well, some places are still counting, but the results are conclusive. It's been a landslide. Uh, just for your first thoughts off the rip, what'd you think?
Well, I did predict Trump to win, and I'm not a bettor, I'm not a gambler, but I feel like talk is cheap, and if you're going to make predictions and pontificate, I think you got to have some money behind it. So I think probably I should have bet, not because I wanted to gamble or make money or I was so
Yeah, conviction.
convinced. Yeah, I just want to prove to myself that hey, this is what I truly believe, and I'm willing to bet, because it's easy to just tell yourself, oh yeah, well I predicted this and I think that, and I'm good at prognosticating this. But unless you really put your money where your mouth is, you're not gonna, you can skew reality.
Right, right. Was there any shocking state, any kind of statistics that you saw that was surprising to you, encouraging? Any kind of fallout or outcome or data reflection that you want to kind of spit on for a second?
Well, you know me, I'm gonna take the conversation to treasuries. I just thought the run up leading to the election was pretty crazy, the way that treasuries were selling off, and we were just seeing bond yields go higher and higher and higher in the face of deteriorating economic data, as well as the Fed continuing to guide the market towards consistent rate cuts as over the next year and a half. So again, I was predicting this and pounding the table saying bonds, US bonds are oversold, rates are too high. But if I really knew what I was talking about, if I really had conviction, then I would have called up JP Morgan and I said, hey, why don't you buy some 10-year bonds for me? And then when they trade down, or when bonds appreciate over the next few months, I would just sell them. And then I would say, here, everyone, there you go. I made the prediction. I was right. But then again, am I a gambler? Am I a prognosticator? What am I really? Of course, our business is not about predicting the future. Our business is not about making economic bets. It's about consistently investing in high quality real estate. So it's not necessarily, the two aren't connected. Like, we don't have to be good at making economic predictions in order to be good at our job. It's kind of, just to make it clear, it's two separate things. But yeah, that was the biggest thing for me. And then what was interesting, so you never know why things are really happening, but people were predicting that the reason why the bond market was selling off was because they were predicting a Trump win, and they were predicting that Trump is pro growth and pro inflation.
Or
And
actually more inflationary, perhaps, in fact, than Kamala.
that's what
The
I'm saying.
the
Yeah,
yeah,
pro inflation. Yeah, no, that's a good point, because a lot of people view the Democrats as inflationary, but the reality is Republicans are
Trump's like to
spendy
spend.
too.
Yeah, he likes to spend as well, maybe in different departments, different areas. But it's funny to that point. Sam Morris, our very good friend, guest to the pod, partner, just the best guy ever. Right? Shout out to Sam. Hope you're doing great today. I hope you're going to church. I'm sure he is. Sam was like, what this is telling me, and he said this weeks ago, he's like, Trump's going to win. And he's someone that has a lot of insights, we'll just put it that way. And he was kind of predicting it before, and the market was predicting it. And it just goes to show pollsters, people of that nature have zero credibility. Media, frankly, has no credibility. Look where people are betting, and look where treasuries, bond markets, and where the stock market, crypto, look where that's pointing. Look where that is, because that's where smart money actually is flowing, right? So it's not right in all cases, but in this instance, this will be a look back and a key indicator for those who are smart, for those who like the investment side of things, to have key points and triggers to look at for the next election cycle, perhaps.
Speaking of crypto, I was also shocked to see crypto, Bitcoin specifically, hit an all-time high. It kind of just came out of nowhere to me. I'm not keeping up with the crypto news, but that just seems crazy. And usually, so crypto is very high beta. So you could say that it could kind of mean like, hey, this is a bit of a frothy time. It doesn't feel frothy, right? People are losing their jobs, the economy's not doing that great. But Bitcoin being at an all-time high, to me, that's kind of like a frothy environment. My only complaint is, if Bitcoin's at an all-time high, they're almost 80,000, which is absolutely nuts. That usually, or historically, recently has coincided with the watch market trading up. but we're not seeing watches go up in value. So, it's a good thing if you're a buyer. It's a bad thing if you're an investor and hoping for your watch collection to appreciate. But it's interesting the lag effects and the way that things sometimes correlate and the way that sometimes things don't correlate. So, right now we've seen the stock market over the last 18 months absolutely rip and do super well. Meanwhile, real estate has really kind of languished, maybe appreciated a little bit off of the bottom. But yeah, things are a little bit, I feel like when things are at the extremes, all correlations go to one. So in 2020 and 2021, when all markets were ripping, everything was correlated because everything was going up together. And then when the Fed started raising rates and we started kind of seeing a crash across the board, real estate, stocks, crypto, watches, everything was correlated as well. Everything was going down in sync. And now we're not necessarily in an extreme environment, if you want to say that. And things are moving in different directions, not necessarily in lockstep.
So what is also really interesting as well is rate cuts. So we've talked about some of the other kind of byproducts of everything going on right now, but rate cuts. So we just got a quarter basis point cut coinciding with a Trump election. We've got the House of Representatives. The count is not final, but right now it's 213 to 202. How it's not all counted right away is barbaric. That's a nonpartisan take. That is just a objective fact. It is absurd that these things are not already calculated. People need to know these things so actions can be done. But it's looking pretty solid that the conservatives will have House, Senate, and presidency in the
The
court.
conservatives.
Yeah, Republicans. You know what I
They
mean?
might be Republicans, but they're definitely not conservatives.
Right, right. The Republicans, in fact, have that, which is interesting. It is. Sorry, I'm gonna get out of screen sharing. That's all going to unfold as we speak right now. We have the rate cut. Treasuries are still pretty high. What do you make of everything going on there? And then also for those who maybe are not happy about the results, but they're real estate investors, what is your positive message to those people who are now going to, maybe have some benefits for, where their money is going to be treated? Because if you invested in real estate with this past administration, the Trump, 45 to 47, that was very friendly to real estate. So what is your message to those maybe are a little bit unhappy about the result?
Well, I think probably the only thing to mention is the excitement or anticipation for bonus depreciation to be brought back to 100% rather than it continuing to sunset to zero. I don't know if that's going to happen. I haven't really heard anything about that, but that would obviously be a boon for real estate at large because that's going to drive more capital into real estate, which is then going to drive values up. So it's not just a good thing for people who are seeking more tax benefits associated with investing in real estate. It benefits real estate all around from a valuation perspective, from a liquidity perspective, because it'll buoy values because it's adding more intrinsic value to owning real estate on a post-tax basis.
Yeah, capital goes where it's treated best. And even Chamath on the All In podcast, our friends at the All In podcast, uh, mentioned that he was really, really sharp on this. No surprise there. He's a billionaire. He said, it's funny, the biggest winners during the Trump administration were actually real estate investors because of the benefits that we get. So I thought that was very interesting. We also were starting to see a reduction and a markdown too of the jobs report, which of all people who has been ringing that alarm and ringing that bell, I give you credit. Rob Beardsley has been talking about this time and time again, marking down jobs. The market is substantially weaker than people think it is. So can you kind of elaborate that, how that tethers to rate cuts, how that tethers to treasuries and everything in between?
Yeah. So it's funny because we had this conversation the other day and you were saying, oh, we've got I forget what you said. You said something like, oh, in our newsletter or in our email to investors, we got to let them know the good news. And I'm like, what's the good news? Oh, well, the Fed cut rates. And well, I agree with you. Yeah, it's good that the Fed cut rates, but it's also, you have to ask the question, why is the Fed cutting rates? And the reason why the Fed cut rates again here in November is because of the continuation of the economic data weakening. So the October jobs report was very weak. The US economy added 12,000 jobs, and that's being generous. Now, there were some headwinds. We had two hurricanes, we had the Boeing strike, So that skewed the numbers down a little bit, but those numbers are always skewed up every single month because they end up being downward. End up being revised downward every time. So already it's an aggressive number that ends up being revised. And even that revised number is still skewed higher because the reality of our employment market is it's propped up by the government. Government is spending money to create jobs, and those aren't real jobs. Those aren't private sector jobs. So obviously the government has legitimate jobs and that legitimately does boost our GDP, but it's financed by debt. So that's not as good as true organic growth. So the reality is if we just focus on private sector hiring, it's not there. It just doesn't exist. And we're actually losing private sector jobs every single month. So with that being said, I think basically, how they basically take about 6 months or a year to look backwards and say, okay, we're in a recession, and they announce a recession, kind of looking backwards. I think September of 2024 will be looked back on and announced as the start of a recession. So I think that's where we are. We're in the early stages of it. We're going to continue to see weakening data, and that's going to keep the door open for the Fed to keep cutting rates. So a lot of people are making that point. I think you made this comment on the last episode or 2 episodes ago. You mentioned higher for longer. Some people are saying higher for longer. Just a few years ago, some people were saying lower for longer, right? So it kind of just goes up and down. It's a cycle. But I do think that because inflation is coming down and because growth is coming down, the Fed is going to be able to cut rates aggressively, and the market's not going to be upset at them. The market's not going to say, hey, what are you doing? And it's going to be all in sync. So we're going to see another cut in December of 25 basis points. And then we'll just see how it's kind of, to me, it feels like a very straightforward situation. Like there shouldn't be surprises. As long as we see the continuation of the trend where the jobs report continues to come in weak, we're going to keep seeing cuts. So job report comes in, cut. Job report comes in, cut. If we get a gangbusters report, which frankly, we did get a gangbusters job report in September, right? But you saw how
markdown, right?
You saw how quickly people forgot about it because the October report was weak. So I think an outlier report popping up is not going to necessarily change the Fed's course. They want to be consistent. The Fed doesn't want to be erratic because that creates volatility. And I think obviously the Fed has a dual mandate, which is stable growth, stable pricing. So they want to keep growth in line. Well, no, actually, it's full employment is their goal, full employment and stable prices. So they want inflation in check and they want people to have jobs. But the third thing also is, and some people argue this is a bad thing, the Fed in a way is a little bit hostage to the stock market, right? And so they want to minimize volatility when it comes to the market. So anyway, those are my thoughts.
So you mentioned this. We've talked about this before. Jamie Roll and I have had concepts. We were sharing emails prior. We get these rate cuts, and then theoretically the stock market goes down. Well, Trump's here now. Does that change everything? Because we're in the rate cuts. The market is kind of ripping right now as before. One theory that I've had for a while is they printed all this money, right? And frankly, the wealthiest people took advantage of it. And the wealthiest people have money in the market and they're not selling their stocks because there's really not a better place to put it right now. Or they're seeing it that way. They're not selling their real estate right now because it's not a good time to sell. So that money has to stick somewhere. And I think we're seeing it reflected upon those prices. They say about 80% of the US dollar has been printed over, this is the last administration, right? Okay, well, that's sticking somewhere, and I think it's sticking there, but people aren't doing better than before because obviously it's harder for people to kind of make their bills make sense. So I think that is an interesting thing there. And let's just talk about why we talk about this, why we care about the Treasury. Now, can you just explain to people the significance of that as it pertains to Lone Star Capital, how we borrow money? Just once more, I think we need to reiterate that. So if you don't mind explaining what that means and also where you think the Treasury will be going here coming up and how that impacts us at Lone Star Capital.
Yeah, absolutely. So, I have right on my phone, I have a widget right here.
Make a wish.
It's 1111, yeah. It's the 5-year U.S. Treasury widget here. So every time I look at my phone, I'm looking at what the 5-year U.S. Treasury yield is. And the reason for that is because a lot of our loans are based on the 5-year U.S. Treasury yield because we borrow 5-year loans. Often we also borrow 7-year loans. So essentially 5-year, 7-year, and 10-year bonds are important bond bonds to look over because they are the index rate when you borrow for commercial real estate on a long-term fixed rate basis. So for us, if the 5-year US Treasury yield, for example, goes up, that's going to make our interest rate that we're borrowing that 5-year loan at go up in lockstep. So obviously we want lower rates, but we don't just want lower rates. The true thing that we want is we want a spread between our cap rate, which is the income that the property generates, versus our interest rate. So in a perfect world, we would buy at a 6 cap and we would finance at a 4% interest rate. And that would be a 200 basis point positive spread, and we'd be printing cash and life would be good, right? So that's what we want as real estate investors. So we, generally speaking, want treasuries to be lower. The thing is, though, like I said, there's no free lunch. If treasuries come down, often people will bid prices higher, which pushes cap rates lower, and it'll keep the spread roughly intact. So there's more at play than just, hey, we want lower interest rates so we can make more money. It's not that simple, right? Because we're in a dynamic pricing world. So the biggest thing that we need to look out for as Lone Star Capital is Treasury volatility. That's what gets us in big trouble, and that's what we've spent a lot of time on this podcast talking about. Because, and you've hear kind of old school investors who have been around for a long time. They are like, yeah, I've made money when a Democrat has been president. I've made money when a Republican has been president. I've made money when interest rates were 10. I've made money when interest rates were 0. It doesn't really matter, right?
We get it. You're rich.
Yeah. And that's true, because the truth of it is, yes, you can make money in real estate when interest rates are 10%, but you're going to need to be buying at cap rates of 12.
Yeah, pricing just needs to reflect where debt is in that market, which sometimes is difficult for prices to change, because if you don't have to sell because the debt market's not in your favor, you wait and sell them because your purchase price now or your exit price is substantially more compressed there.
Yeah, prices are a lot stickier than interest rates. Interest rates trade every second when the bond market is open, and so prices move in an instant. But real estate values in the private market don't move in an instant, right? A seller has emotions. A seller has an investment committee. It takes time, capitulation, meetings, thinking, change of heart, change of mind. So that's why pricing moves a lot slower on the sell side than interest rates. So that's why volatility can really hurt us. Even if a seller is not changing their mind, even if we, let's say, go to a seller, we agree on the price, they agree on the price, so we're going to buy this deal for $50 million. Okay, cool. Then while we're under contract for 2 to 3 months, if the treasury market is volatile, we could see treasuries go from 3.5% to 4.5%, and that'll blow up any deal. Any deal in the world, doesn't matter how good it is, it'll blow the deal up. So, which is why I think it's kind of silly when investors go to a sponsor and they say, well, what would happen? Like, or how are you protecting yourself against rising interest rates or something like that? It's like, well, you can't. There's no way. There's no magic answer there, right? Same thing. Oh, insurance has doubled. What are you doing to protect against that? It's like, you can't. Sure, there's maybe some things that you could do to get fancy. You could create a captive policy, but at the end of the day, if insurance is up, those are uncontrollable expenses. So that's a little bit getting off track, but the point is volatility is not our friend. So we prefer, doesn't really matter where rates are. It just matters that they don't go in any particular direction fast. They can go slowly, but fast is messy.
And going back to our friend Sam Morris, who's going to be the super du jour today, right? He was mentioning that, if there was a 2 BIP movement at some point in a month, that was big news. Something was going on. Now we're in this weird world where you're getting, 20 basis point cuts or drop downs or fluctuation, crazy movement one way or another, which is, not normal from a historical perspective, he was explaining to us. So that's just kind of an interesting concept there. As I mentioned, we've been on the right side of this when we do rate lock. And that's kind of why I wanted to bring that up, because so many of our investors are ready for, placing their equity in our most recent deal, which if you want to learn more about our opportunity, what we're raising for our 2024, what we did now, and what we're doing in 2025, please email me. It's Craig@LSCRE.com. You know it, but I had to say it. Why this is important for you, why people ask us all the time for, when we rate locking, what's going on. I just want to make sure that people understand it's based off the treasury, not, oh, rates got cut. The other thing that's interesting too is if rates really, really float down, or treasuries really, really float down, that does not necessarily guarantee that we can get that pricing, because there are floors that the lender sets to make sure that they don't have a bad trade there.
You're killing
So
me.
yeah, so unfortunately, that is something we have to work through. But I kind of just want to touch base on that. Let's transition into the next topic, which is double waterfalls. So I had a really great question from a future capital raiser for us. Hopefully, shout out to you. You know who you are, regarding how the double waterfall situation works, what it means, and this is really not for those kind of investors of ours who are looking to be an LP. This is more for our capital allocator friends, our fund manager friends who will set up a waterfall, or sorry, an SPV, a fund of funds that kind of flows into our deal structure. And if you are looking for more up-to-date information pertaining to how that works, how it functions with their great friends at TribeVest who set up as their back office team, please refer back to the episode that I did on Fund Friday with Travis Smith and Seth Bradley, who did an incredible job explaining their product type and the need that they provide, the solution they provide. That'd be very helpful. But Rob, I'm sure you're being perspicacious and pulling up the underwriting waterfall setup right now, which is something we're going to speak on. So there's some misconceptions there. There's some confusions, regarding how this structures and flows. So if you don't mind doing the honor of kind of breaking this down, because sometimes I struggle explaining it. I understand how it works in theory, but verbalizing it is always something that's a little bit sticky or hard for me to kind of stick with.
Yeah, for sure. So let me share my screen and we'll jump right into it. Let's see. Google Chrome is requesting to bypass the system private. Should be fine. Entire screen. Let's do it.
You're a Chrome guy now, huh? That's interesting.
No, I'm most definitely not a Chrome guy, but Riverside doesn't allow you to. I can't do Riverside.
I got more
Safari.
Chromes than rims.
Like Cat Williams said, I got more chrome on this belt than you have on your car. Okay, so
That was good.
All right, so for the purposes of this discussion, we're going to use Cortland Vizcaya, which may or may not be the current deal that we have under contract.
Can't speak to it. Can't say.
We're not publicly advertising, but if you are interested in learning more about our investment opportunities, you can reach out to Craig. His email is craig@lscre.com.
Thank you.
So just to get everybody acquainted with the situation. So on this deal, we're not going to underwrite the deal. We're not going to discuss
This is not a solicitation.
We're not discussing the merits of the deal. We're simply using it as an example to discuss a double waterfall structure, which I will also explain what that is. And I'll do that now, actually. So a double waterfall is a partnership structure where you have the main deal level waterfall, which is just simply the promote structure, which typically includes a preferred return and then a return of capital, and then a promote or a carried interest or some sort of split, right? So for this deal, we'll just keep it simple. We have an 8% preferred return, which is a minimum return owed to investors, and then a 70-30 split thereafter. So investors thereafter getting their 8% minimum compounded annual return, they're going to then get 70% of the remaining profits above that. And then, of course, to make it a little more complicated, in this deal structure, we have a second hurdle where after investors have earned a 15% IRR, any profits or cash distributions above that are split 50-50. So the split changes from 70-30 to 50-50 above a higher tier return. So after investors hit that 15, which is a great return, then it gets more favorable for the sponsor. So it's kind of a tiered incentive structure. So that's the base structure there. And that results in projected returns for investors of 16.6% IRR and a 6% cash on cash. And then, of course, a 2.04x equity multiple. But it's just important to memorize, for the purposes of this discussion, these numbers: 16.6 IRR and 6% cash on cash. So that's what an investor investing in this deal is projected to earn based on that waterfall. So a double waterfall is when a fund of fund invests in the main deal. So you have a fund that pulls together $1 million. And then that $1 million fund invests as a single check into this main deal. And that investment is subject to a waterfall. Now, however, because this fund manager is pooling together $1 million, they get access, or they're able to negotiate a better waterfall structure for themselves and for their fund, right? And it makes sense, right? They're basically buying in bulk. They're getting a bulk discount. So instead of being subject to a 70-30 split over an 8, they get in this case, a 80-20 split over a 9% pref, which is substantially more attractive than a 70-30 over an 8. So, and again, the reason why they're getting that is because they've pooled together $1 million. $1 million is buying in bulk, whereas a $50,000 investment is just the minimum. So that's the rationale. And then what happens from there is the fund manager pooled together $1 million or $4 million into this vehicle, writes the single check into the main deal. The main deal, there's a waterfall at the main deal level. Then the resulting distributions flow to the fund level. And then at that fund level with $1 million, there's another waterfall where the fund manager earns a performance split there as well. And then there's a remaining distribution to the investors of the fund. So it's there's a lot going on there, right? Because there's a waterfall and there's profit sharing at the deal level. Then there's profit sharing at the fund level. And then the investor inside of that fund finally gets the resulting returns there. So conceptually, you think about that and you go, wow, gosh, the investors in that fund to fund are paying a lot in fees and paying a lot in promote because they're paying it effectively at the deal level and then again at the fund level. Which is why they call it a double waterfall or a double promote. It's one, then two, then me, right, as the final investor inside that fund. But if it's structured correctly, and like I said, in this case, it is structured correctly because at the fund investing a larger amount is getting us more attractive deal level waterfall. The investor inside the fund can essentially earn a return commensurate with investing directly in the deal, skipping the double waterfall and investing directly at the regular terms because of the more attractive deal level waterfall for the fund to fund. So in the end, it all works out, but it conceptually sounds more expensive because it's one waterfall, two waterfall. But as long as the math checks out, it all works out. So that's the explanation of double waterfall for people who are unfamiliar. Now, for people who are familiar with double waterfalls, people get confused because they sometimes think the math is simpler than it is. And I'll give you an example. People think that if the deal is structured as, let's say, an 80-20, like in this case, right? It's a 20% promote, which means 80% to the fund, 20% to the sponsor. And then at the fund level, the fund manager is going to take a 10%, a 90-10 split. People think, oh, well, then that's in the end 70 for the investor in the fund and 30 for the manager, right? 20 for the sponsor, 10 for the fund manager. But that's not how this works because it's not happening at the same time. It's happening sequentially. It's a double waterfall, right? First, we go through this waterfall, then we go through this waterfall, and then the investors inside the fund get the returns.
I want to make it very clear, we will never offer a 90-10.
Well, yes, that is true. We will not offer
90-10. That will not happen.
But just to clarify, I wasn't talking about that. I wasn't saying.
I just wanted to throw it in there for my own selfish purposes.
Yeah, just to let everybody know that
PSA.
We're not giving away our services for free. So when I was mentioning 90-10, I was saying that at the fund level, right? The fund manager can charge whatever they want at the fund level, right? If they want to screw their investors, they could charge a very high promote, high fees, but then their investors would eventually catch wind of that and not be happy. And they'd say, hey, why don't I just invest directly with Lone Star? Why am I going through this fund, right? So, and the reason why people would go through a fund manager is because perhaps the fund manager is structuring a deal that's more favorable than investing directly, or perhaps the fund manager does a good job of doing due diligence and communication, and so the investor is in effect married to that fund manager.
And you'd hope your fund manager is super smart. They're going through tons of deals. This is what's best for the investor, not just what the fund manager is going to make, but they have that ethics. They have your heart and mind, and they go through all these deals. They get pitched relentlessly, but they sifted through all of these. And if it's good enough for them, you should be smart enough to invest in that deal. That's the fund manager that we want.
Right. And then another benefit that a fund manager could offer their investors is investing smaller amounts. So if a sponsor like us has a $50,000 minimum and an investor wants to invest $25K, a fund manager perhaps is open at a lower minimum, and they'll take in that $25K check, aggregate $1 million, and then write a single check into our deal. So those are some of the benefits there of a fund-to-fund partner. Okay. So now I just want to go through some math, and I'm doing this on the fly. So I'm really not prepared to, like, I don't really know how these numbers are going to look. We're just going to do this together. And I think this will be an interesting exercise.
Also, I do have the question in the chat. So after we do all of this, Rob, if you wouldn't mind, please answering that question, maybe reading it out loud and then going from there would be great because my reading out loud skills are inferior to yours.
Okay, let's try to do this at the same time.
Okay.
So, question from Fund Manager. So just making sure I fully understand the fund-to-fund economics. For the 9% for the 9th% of preferred return in the deal, essentially the percent where LSCs promote has yet to kick in and my LP doesn't get the full preferred, the dollars that come from that percent of preferred would be split just between my LPs and me. And then for all dollars after that, they're split 20. So I can't even read the rest of this because it's just wrong, and it's more wrong and confusing than it is helpful. So this is what I'm trying to explain, and it's
respectfully.
Yes, respectfully, and yeah. So
these are the misconceptions. Sorry to cut you off. These are the misconceptions that we really want to harp on here. If you're a fund manager looking to raise for our deals, we're talking our book here today. Sorry, not sorry, but this is important for you to know. And then also, if you're an investor, seeing fund to funds, seeing how this breaks out. This is, as JC would say, open kimono. We're opening everything up here so you can see it. So we want to be transparent here. And in order for us to be transparent, talking through this is very important. And then also for our future fund manager who asked this question, you having understanding here is very valuable. So with that said,
yeah,
let's go.
So I tried to set the stage for this, and I don't even, like, this is really complicated, I will admit. And so I understand. I tried to explain the misconception, which is I said it before, and then I read it again. Like, so reading the question is exactly what I said earlier, which is people have a misconception that if the sponsor at the deal level has a 20% promote, and then the fund manager at the fund level has a 10% promote, does that mean that the investors get a 70-30 split? Because it's 10 at the fund, 20 at the deal, so it's 30 in total, 70-30. But that's not how it works, because it's not sequential. They're not stacked on top of each other. It's one, then the other. You have to go through the entirety of the first waterfall and then go through the entirety of the second waterfall. So I'm going to try to show that and illustrate that. So before we do, I'll just show you how ours is set up. So like I said, if you go through the deal level, right? Like I said, it's the 30/8, 50/15. You have a 16.6 IRR and a 6% cash on cash. So, oh gosh, I'm just blowing it here. Okay, so now with the fund manager investing $1 million fund, you have an 80-20 split over a 9% pref. And what that projects is a 18.8% IRR, right? Which is better than the 16.6. Now, of course, the fund manager is going to charge fees. The fund manager is going to charge promote. So in this case, we drew up a hypothetical fund for $1 million. We're projecting that the fund manager charges a 2% fee on the capital upfront at closing. They give their investors at the fund level an 8% pref, and then they charge a 12.5% promote over the 8 pref at the fund to fund level. So they're taking these resulting cash flow distributions, 18.8%, and then running through another waterfall at these terms, net of this fee. And there's also fund to fund startup costs, legal, accounting,
and that's sometimes you'll see the only or one of the big discrepancies you'll see with the fund manager's returns and numbers and what ours would be a slight drag in the cash flow because the administration costs on an annual basis that the fund manager has to pay for that comes out of the fund level. So there's a slight cost and drag on it. And that's why I say, if you're raising less than $500,000, it starts to really not make sense unless you want to kind of pay the capital to raise in a compliant manner. So that's why I say that there. That's how that cookie crumbles.
100%. Yes, that's exactly right. And you'll see that right here, because with this structure that we've proposed here, just like this, you see the resulting returns for the LPs inside this fund to fund is a 16.9% projected IRR, which, if you remember, that's higher than the 16.6 projected at the deal level. However, a 5.8% cash on cash projection instead of 6%. So like you just said perfectly, slight drag in your cash on cash, 20 bips drag on your cash on cash, but 30 bips better on your IRR. So it's basically a wash. Higher equity multiple, of course, because higher IRR. So in the end, this is how you make it all work. Better waterfall for the fund to fund at the deal level. So we're giving up a little bit better, but in exchange, we're getting capital in bulk, getting $1 million fund to fund, right? Which is typically our minimum. That's what we want to see. We have partners who do $1 million, partners who do 2, 3, 4. So that's our sweet spot. We're looking for partners who can raise $1 million to up to $5 million, really. But really, we're seeing kind of that $1 to $4 million be attainable in that sweet spot. So please reach out to us if you are a fund manager raising in that amount. Love to work with you. Love to add you to our amazing team. So here you have it. Everyone's happy. We're happy because we have great partners that bring us capital consistently for our acquisitions. We have our fund managers happy because they are making money, obviously, for the capital that they raise. And we'll get into that in just a second. And then the LPs in the fund that our partners are raising for are happy because they're getting returns commensurate with investing directly, if not even higher at times, just depending on how the deal is structured. For example, if the fund manager wants to be a nice person, they could say, you know what, I only want to charge 10% promote instead of 12.5. And now look at that. The LPs in the fund of fund are getting 17.1 projection.
And let's also scroll down here to see what the compensation structure is. Oh, wow. So if they did that, it'd make less than that 10 to 13%, 10 to 12% bogey that we kind of designed out for them, which is, fair on modest projections. So you could be very friendly with that, or you could be not so friendly, charge higher DD fees. That's the beautiful thing about the fund to fund structure is it's kind of open to interpretation. And what we do from an inside baseball perspective is we kind of back into this math. Our fund model is available about 10 days prior to the far and wide public launch, basically where we're sending this out through email campaigns and things of that nature. So what we want to do is once the underwriting is more baked, we've got a, more bigger understanding of where our debt quote will kind of look at. And, once we get the insurances lined up, once we have an understanding of the CapEx budget, then we go to our underwriting model. We kind of fully bake that there. And then what we do from there is we create the double waterfall, set up the fund of fund structure. Once we know those numbers are more definitive, and this is the computing here. The worst thing we want to do is kind of send you that structure too early, have some numbers change that move in the wrong direction. And then to have that not be, mirroring, matching what our returns look like. So we want to make sure that you get paid a nice fee for your efforts here. We want to make sure that your investors get a good fee. They're not getting feed to death. And it's very competitive to what our investors and our returns will look like. It's slightly higher, not on the cash flow here. As you can see, that 16.9%. Remember what Rob said. Remember that 16 number. It's slightly higher here, but we think that's fair for the slight reduction of cash flow. It mirrors and matches. It's not going to be some alpha. We're not going to be providing these terms that are far and away better than our investors, because why is that fair to them? But we're also not going to have a world in which you're not making anything and your investors get a bad deal either. So this is a win-win. We're looking for win-win partners in our structure, not people that want to make 20 points off of what they raise for. That's not in line with, what we think is
screwing
appropriate.
Your investors.
Yes, correct.
Yeah, all good commentary there. So here you can see it's a win-win-win. The investors inside of this fund of fund win because they get returns commensurate with investing directly. The fund manager wins because they're projected to make 11.3% on the equity that they raise over a 5-year period, which is very market. And again, this is based on conservative estimates. I don't want to get too distracted here from the main question, but just to give you a little funny point here, projections are not projections, and how much you're projected to make as a fund manager is not the same across every deal. Because if we were more aggressive as a sponsor in our underwriting, for example, we could knock this down not even by 50 bips. We could just go 5.25 exit cap, which I still think is very reasonable. But we chose a 5.5. But if we just bump the exit cap by a quarter point down, now all of a sudden we could go to our fund manager and say, hey, you're making projected 13.1.
And let's also go back to what our investors would get projected to them as well. So let's go now to our summary section.
And knock down this?
No, yeah, just go. Yeah, well, if you just went to the model, it wouldn't be a difference. But yeah, go to the summary now.
It would be different because it's the deal
Yeah,
level
but
waterfall.
you still get that though if you change that exit cap rate, enter sum rate, it's not affected. At any rate, uh, if you look at that there, the cash flow, of course, doesn't change, but these are the exit assumptions. So
I see what you're
I
saying.
I really want to harp on this. This is something that I say all the time. If you've been on a phone call with me from an investor perspective, if you've been on a phone call from me with a fund manager perspective, if you see me speak on a panel, I just said this at the Fully Funded event. Shout out to our friend Sam Silverman. We are not in the business of showing you the craziest returns. We are in the business of buying good real estate with reasonable assumptions and fundamentals here associated. We're not overpaying for these deals. We're not underpaying. These are good market rate deals. We'd like to underpay. But the point that I'm making here is that if you are a fund manager or an investor looking for the highest returns possible, you are just looking at how you're going to get lied to. We're not going to project the highest numbers. I hear instant red flag if you're looking to, make XYZ, then that tells me that you're really just self-interested. You're looking to, frankly, make an outsized amount of money for your return there or for your investment there. That probably does not line up very well on a risk-adjusted basis or for your investors. And then
Short-term
similarly, if you're an
thinking.
investor, if you're kind of a commodity investor, what does that mean? You're basically looking for someone to give you the highest projections. It doesn't make sense because guess what? We are all in the business and the space that we play in particularly. This is $30 million plus multifamily apartment complexes in growth markets. Those are market rate deals. There are no screamer off market. How could you not? That's so much better than anything else because those owners have a fiduciary to their investors. No one's giving away deals here. So you're overpaying with conviction the most, like we do, on that said deal. We're all underwriting the same. If you see these numbers that are far and away, way higher, please raise a red flag and ask him how that's possible. And please underwrite the deals and go through the projections and go through that modeling and say, how does that make sense? And then if you compare it to a more conservative deal, I would almost say with a high level of certainty, the highest level of certainty, that if you put the more conservative deals inputs in there compared to the aggressive, and then you flip flop them, those deals would look wildly different. So do you want to talk about maybe that as well? Because, from our end with our investors, what I like to say is this is what we're looking for, smart deals. And you also made a point to me that a deal is roughly always going to shake out to what number. So can you just comment on that, please? So I'm not taking crazy pills here alone.
Yeah, sure. And I do want to bring this thing home soon here. But the point is majority of multifamily deals of similar risk are going to underwrite to around a 15% return. That's just what they are. And it doesn't matter what numbers I put in the spreadsheet. It's not going to change what the return is at the end of the day. So we're only hurting ourselves if we go to our investors and say, this is a 20% return projection. And then the deal ends up being 15. Because while 15% is a fantastic return, if the expectations are set high and then 15% is achieved, people aren't going to be happy, even though 15 is a great return. If we go out and give a more conservative projection, like, hey, it's going to be 15, and then we hit 15, everyone's going to be happy, and it's a great deal. So it doesn't really benefit when it comes to savvy sponsors and savvy investors. Everyone's on the same page. But the thing that's such a shame is there are sponsors, of course, out there, and this will always be the case. This is just how business works. There will always be sponsors out there who are short-term thinking, and they're going to project high returns to attract what I call the hot money, or just the less sophisticated investors who, or like you said, the commodity investor, basically the investor that's running around with their heads cut off and just looking who's offering me the highest number, and forgetting the fact that the offer is simply a projection and not something that you can take to the bank. All right, so we only have a couple minutes. I'm going to try to do some math here, and I'm going to try to finally explain the math behind a true double waterfall and not the fact that they're not just stacked on top of each other. So, and I really don't even know how I'm going to present this math, but let's just try to see if we can figure this out together. So let's do this. Okay. The way I'm going to do this is I'm going to assume that the fund-to-fund raise, this isn't going to be perfect, but it's going to be pretty close to perfect. I'm going to assume the fund-to-fund raise is equal to the total equity for the deal, which will be this number, 15,742. Yeah, so that number is fine. So we're going to make it the inverse of that, positive. So you're raising 15 million, which is basically what this is saying is the entire deal is funded by one fund to fund, basically, that is that is under this structure. So the whole deal is just one big double waterfall, when in reality it's many double waterfalls, right? Because we have multiple fund of funds. So we're raising $15 million, and then one person is a fund of fund, another group is a fund of fund. And so then there's multiple double waterfalls happening. But for the purposes, we can just do one. So in this scenario, the 15.7 million is invested, and the fund of fund receives this return, and the sponsor earns this promote. So let's take note of that, and let's say sponsor promote, and we're going to make that equal to this number here. Where am I? Here we are. Okay, so that's that. Now the fund of fund promote is equal to this 1.5 million right here. Okay, so how do we get there? Just to recap,
is that a $1 million tranche?
This fund of fund promote.
Totality.
This fund of fund promote is assuming someone raises a fund of fund for the entire equity check.
Okay.
Right. So it's still the 11.5 projected comp based on their raise. So what we have here is, let's just do total, and that's just this plus this, right? Now, how did we get here? Just to recap, we got here by, first, there's the main waterfall, which is 20/9. Then the deal flows through that waterfall completely and ends up here. And then there's another waterfall that happens, which is the 12.5% promote over 8 at the fund to fund level. And then that waterfall happens here, which results in the end, the fund manager making this promote right here. Okay. So it happens sequentially. So when I total them up, it's not going to equal. What it's not going to equal is the sponsors. And you know what? I'm going to make this even more straightforward. I'm going to change this to 8. So now both promotes structures have a 8% hurdle. So that'll just change the numbers slightly, but no big deal. It just made the sponsor promote a little higher. But now, so the sponsor promote percentage, I know this is really messy and not.
This is terrible radio, by the way. So if you're listening only, I apologize. If you care about this, hit pull up in the podcast form.
Yeah. No, for sure. This is the only way that we're gonna. There's no way to make this.
This doesn't make sense. Yes, unfortunately, Ray Charles may struggle to figure this one out. But outside of him, pull up YouTube, please.
Yes, for sure. Okay, so then this is the promote here, right? It's the 12.5%. And then if I total this, come on, here we go. Total this plus this, we are here. 32.5% is the total promote. But that's not going to mean that it's going to total. This is not 32.5% of the promote on top over the 8. Because if we go to the original waterfall and we go to the tier 2 here. Oh no, hold on. It's complicated because there's actually 3 waterfalls here because of the HHA partnerships. It's pretty complex, but just ignore all the extra numbers if you can. The point is here's how this works. So the main waterfall, there's an IRR check, right? The first hurdle is 8%. So in order to hit 8%, you have to return 18.5 million back. Then there's 15.7 million of remaining profit. If I take 32.5% of that, that is 5.1 million. So you see, that does not equal the 4.6 million because the 2 promotes aren't stacked on top of each other. I just don't think there's a way I'm going to be able to explain this that well, but it's not the 20% promote on the sponsor level and then 12.5%, and then you add them, and then it's 32.5%, and then you're taking 32.5% of over 8% at the deal level, right? You have to go through the whole waterfall at the deal level, and then you take those cash flows, which there's at the end, it's this, right? Or it's technically this. So then there's 31.5 million. So then in order to hit that, you've got your IRR check. There's 11.8 million here subject to promote at the fund to fund level. And you're going to take your 12.5% of this, boom, 12.5%. And that gives you the fund to fund promote here. And that's how you get to the total promote, the sponsor promote, fund to fund promote, the total here, right? Which is the 20, 12, 32 and a half. It does not equal 32 and a half over 8 in total. They don't total up. So hopefully that was helpful. Hopefully that makes sense. It's
We
just
got to end it. We got to end it. Yeah.
But that's conceptually how it works. Maybe one day we can get a drink and opine on this and pontificate and whatnot and have it really click.
Right. Well, thank you so much for listening. If you're a fund manager, why are you listening to this and why haven't you called me yet? You're silly. You're a silly goose. You don't want to do unique deals, I guess. You don't want to work with some incredible people, I suppose. If you're a fund manager watching this, haven't reached out. If you're looking to reach out, once more, the email is Craig, CRAIG, at L, not I, LSCRE.com. Good night, good day, good morning. We appreciate you watching. We'll see you next week with an interview with Chris Larson. Peace.